Hey guys, Cameron here with Emerson Property Management. Every week I bring you tools, tactics, strategies, lessons I've learned, things that have helped me build up a sizable rent portfolio in about 2 years and now manage that portfolio. Today, guys, I want to talk about taking a long-term view on your rental property. So whether you have 1 or 50, we want to make sure that we're taking a long-term view. This real estate is not a get-rich-quick scheme. I have to continue to harp on that, especially for new folks that bring on properties that are looking to get every single dollar out today versus, hey, let's do some renovations, repairs, some upgrades of things that are gonna keep this property producing fruit for years and years. So I just threw together a quick little case study here of one of the properties that I bought personally here in Houston about 5 years ago. And then I'll show you what it's done, what it did back 5 years ago, and what it's making now, and the difference, and then we'll talk through that. Before I get into that, again, I appreciate y'all tuning in. Give us a like, subscribe, comment below if you like the video. It really helps us out and grows this. We do all this for free, so any of that really helps us out. Okay, so let's get into this. The property is Autumn Hills. Year one, the property rented at $1,350. So I'm not going to get into all the repair and renovation data and what I paid for it. Really doesn't matter. The property rented at $1,350 and it was worth about $140. So I bought this property and was all in about $100. But again, for the rate of return and whatnot, it's kind of irrelevant. The property made after CapEx, property management, lease fees, all that stuff, it made about $125 a month. That's not that great, right? I mean, would you get out of bed for $125 a month? I mean, most people are saying, well, why would I even take the risk, Cameron? Well, if you guys read ahead, if you're a little faster than me, this is year 5. So the rent's now $1,695. We just leased this place about 2 or 3 months ago. And at the time of this recording, this is mid-2022. This was back in 17. The property is now worth $215,000. And we're making, or I'm making about $450 a month now in cash flow. So that's about 75 grand in appreciation over 5 years. Not too bad. 75 grand in 5 years, plus $450 a month in cash flow. So what did not look appetizing and worthwhile in year 1 is now an awesome deal and made quite a bit of money in year 5. I put this little question mark down here. What do you guys think the rents are going to be in year 10? What do you think this property is going to be worth in year 10? I don't know. Is it going to be worth 300 grand and, renting at 2,500 a month? I really don't know. But I can tell you that a lot of people can't stomach this because year 1, or just say year 2 or 3, they're like, oh my God, I can cash out and make 50, 60 grand on this. Kind of like flipping. I don't care about that. I don't care that there's $75,000 in this property that's just sitting there. That's not what bothers, or I don't even think about that. I want to make sure my return on equity is good. I've got another video, check out up here about difference between return on investment versus return on equity. And you have to understand that as an investor. But the more that you can sit and wait and let real estate do its magic, the more money you're going to make. So, this is 75 grand over 5 years. That's what, 15,000 bucks a year? The other point I'll make, and I've talked about this at length, is it's not all about cash flow. This cash flow only makes about $5,000 a year. But just from that 5 years, I made $15,000 a year in appreciation. And hopefully, I always use a very, very conservative 2%. We've had some crazy years here recently where the properties have gone up skyrocketing. But I use a 2%, and even then, that's over 6,000 bucks. 6,000 and 5,000, that's still 11 grand a year. Doesn't take too many properties. We got another video up here talking about you can just buy 1 or 2 properties or 2 or 3 and really change your life and build financial freedom. So this is one deal, guys. I could have put this isn't the best deal I've ever done, and this isn't the worst. But don't get so the purpose of this video is do not get so caught up in this number. Now, again, don't overpay. Don't pay $150,000 for $125 a month. But don't be so concerned with this number that you miss this huge opportunity. That's a lot of money. $15,000 a year, and now $5,000 a year coming in. That's almost $20,000 a year on one property. Not a bad deal. So would you have paid that? How much money would you have paid for that? Would you pay 10, 15, 20,000 bucks down for that? And again, who knows what that's going to do in the next 10 years, 15, 20, 30. When it's all paid off, what's it going to make? That's net of everything, all expenses, debt servicing, the whole 9 yards. So I hope that was helpful, guys. Don't get so caught up. I don't want you to buy negative cash flowing deals. Do not misconstrue my words. If you are buying a negative cash flow deal, make sure that you have some cash flowing properties to offset that, because you never want to have to rely on your own income to pay for those. I've done it. It's kind of, I haven't done it where it's a substantially negative, but you've had to use your own income to front repairs and, an AC or furnace goes out. We had the Texas freeze. So you want to make sure that you have some reserve set away for that stuff. And if you do a negative cash flow property, you're going to be relying on your income to help with that property. And that's really not the point. So buy a couple cash flow properties. Then you can add a negative cash flow one that maybe you're going to be playing on appreciation. And don't forget, don't look at it just a snapshot. Play the long-term game. Real estate's a long-term wealth builder. When I own this property in year 10, I'll come back and do a video and we'll look at what the numbers are then. I appreciate y'all. Thank you. If you have any questions, comments, concerns, comment below. Cheers.